Joining me here at Post 9 is the CAIS founder and CEO and chairman, Matt Brown. It's good to see you.
Scott, great to be back.
Especially now. I mean, you've built a whole business connecting investment managers with asset managers, specifically around alternative investments, right? So the private markets, I guess, could be a little more stable in crazy times, but also, as I said, less liquid. So how should we be thinking about this now?
Yeah, first of all, thanks for having me back on. 15 years ago, we built a platform that connects financial advisors across America with some of the greatest alternative asset managers. And we've been providing a bridge for those two communities to be able to invest, learn, and allocate to those strategies. And you're absolutely right. Alternative investments, just simply due to the fact that they are illiquid in many cases or have long duration liquidity, they're not volatile like the equity markets are today. It's too early to tell, in the recent week or so what the impact will be on alts going forward. But we have enough data going back to say the global financial crisis or COVID, moments of stress in the market where you see that, with every crisis does come an opportunity. And the alts managers that are on our platform that we've been speaking with have a lot of dry powder. And they're excited now to carefully see the new environment and to deploy capital.
I guess, when you talk about private equity, if you look at the stocks of many of those companies, they haven't done well in this environment because people have had to change their expectations for realizations. The investor who wants a piece of the private equity pie says this is going to be a much better environment than the prior for private equity realizations. Thus, the stocks are going to go up. My investments in the private market is going to do well, and yet we're sitting on our hands, waiting for stuff to happen. I mean, therein lies some of the issues that can exist.
Right. For the few private equity or private credit firms that are actually public, and investors have chosen to buy their equity, there is, of course, the volatility, and market volatility affects all publicly traded companies. But the fundamentals of these companies, the private equity firms and their underlying investments, do have that stability and that benefit to a client portfolio that obviously allows for less correlation, more diversification. And that's why what you're seeing in the individual investor world is a move away from that 60-40 portfolio to really the 50-30-20, 20 being alternative investments that get the benefit of that illiquidity premium and the lack of correlation.
That's exactly what one of our guests from JP Morgan Asset Management said, but 15 minutes ago. 50-30-20 was, maybe the new breakdown. And maybe this was the most stark reminder of what could happen with 60-40 when you have upset in the equity market and in the bond market at the same time. Let me ask you about private credit. $1.5 trillion asset class and fast growing, obviously. Yep. I read, earlier as I was preparing for this, that some are suggesting that this moment could be the first very big test for private credit since it really started exploding as an asset class. Just given where we are, the uncertainty around the economy and what a downturn could mean for private credit assets. What do you think?
Look, I think there's a lot of conversation around the size of the private credit market. I'm not sure why that is necessarily, but that seems to be a topic that keeps coming up. On a relative basis, it's not that large. It has grown quickly. But private credit and private credit managers are at the top of the capital stack, and they're insured by all the equity in the company. In a market like this, I think that's where I'd like to be. I think that's where you'd like to be. So we monitor the private credit managers on our platform very closely. Apollo, Ares, others, and I will tell you that speaking with their CEOs, their confidence levels right now that to look at the dry powder that they have, re-underwrite their pipeline, and start deploying after this volatility or market disruption, the confidence is quite high.